In 2008, the banking system was bust. You and I have been paying to rescue it ever since. Nearly a decade on, I think the old system as we know it is heading for extinction. Estimates of the amount of taxpayer money used to shore up the UK banking system since the financial crisis vary from £456 billion to £1.2 trillion. It's a bill we'll be paying for generations to come, and yet my bank still treats me like something they stepped in on the pavement. I still have to wait in voicemail hell for 30 minutes before speaking to someone in India who can't solve my problem. And if it comes to a loan for my business, the answer is no. Now, what was the question? Broadly, the banking system has divided into the high street banks for retail customers and the commercial banks for investment. Lines did become blurred, and it was the risks taken in the securitization of poor quality mortgage loans that eventually tipped the sector into crisis. If you've read or watched The Big Short, you'll better understand the crazy environment in which it all happened. Those same ratings agencies that just downgraded the UK post-Brexit were telling everyone that these subprime bonds were AAA rated when really they should have had "now please wash your hands" printed on them. A zero interest rate policy, QE type money printing and central bank bond buying has helped the banks recover by giving them a business model that even George Osborne could understand. Borrow money for nout and lend it out for 6 to 12%. Somehow they still struggle to make money even with this gift from the government. Their European and Japanese counterparts on the commercial side are now struggling with the negative interest rates imposed by their central banks, so it actually costs them to place funds on deposit. This is meant to be a penalty that encourages them to lend the money rather than hoarding it, but it doesn't seem to be working. I believe the high street banks have some deeply entrenched problems that leave them ripe for extinction. They have expensive branch networks carrying out mainly low-value transactions. They have ancient IT systems, some dating back to the 1960s, that have been bodged and band-aided but rarely completely replaced. They have deeply entrenched cultural issues that make it impossible for them to treat their customers properly. And they have a truly terrible PR image that they've made no inroads to improving. I've talked before about the concept of disintermediation, cutting out the middleman. Two developments in the last 5 years make this a reality. One, cloud-based applications that bring mainframe computing power to the smartphone in your pocket. And two, a preference among millennials for more flexible approaches to finance through crowdfunding, asset sharing, and settling for renting rather than buying their home. Alternative banks have sprung up with no physical presence. Many of my generation are still nervous about buying stuff or paying bills on the internet versus going into a brick and mortar shop or the local bank. Futurist Daniel Priestley suggests that 2015 was the year we finally stopped making a distinction between being online and offline. Basically, instant broadband access everywhere makes it no different to breathing or walking. It's just something that's always there. We take it for granted and fully integrate it into our lives. So it will be with banking and investing. Crowdcube's Luke Lang tells of the guy who invested £1 million in a new company on the UK's leading crowdfunding platform from his iPhone at 5 past midnight. We're now seeing the rise of robot financial advisors. I know they can't be much worse than the human ones. And we're seeing challenger banks on the high street like Metro, where customers face the shocking experience of a bank clerk smiling at them and offering them a drink of water. We've even got Handelsbanken appointing local managers empowered to make lending decisions by getting to know the customers and business owners who live near the branch. Are you listening, Barclays, HSBC, Lloyds or NatWest? No, I thought not. And then we've got the whole area of cryptocurrencies with Bitcoin very much in the vanguard. If you haven't already read Dominic Frisby's definitive book, Bitcoin, the Future of Money, I'd urge you to do so. Dominic is investing heavily in the blockchain technology that underpins Bitcoin, and I think it could prove to be as transformational as the internet. Even the Bank of England is looking at it. For investors, I want to finish with 3 key points to remember from all this. First, a reminder that money you deposit in the bank is no longer yours, it's theirs. Hence, they can refuse to give you access to it, as happened with Northern Rock, Greece and Cyprus. Second, how long before retail current accounts have the same negative interest rates as the commercial banks are experiencing? Mark Carney has already talked of lowering UK rates towards 0, which I'm sure will be the trigger for either charges on current accounts or negative interest rates. And thirdly, as Tim Price has made us all aware, we can expect a war on cash. If you keep it under the mattress, you'll soon be getting a better return than you are in the bank. So the powers that be won't stand for that. It's already impossible to move anything above trivial amounts of cash without getting the special drug dealer service. They could ban it altogether or stamp it with a valid until date so it's no longer legal tender when you dig it out the garden. Here at Elite Investor Club, it's our aim to keep you up to speed on these developments so you can stay one step ahead of the politicians, the bankers, and the mediocre majority. If you haven't already joined, the interesting times ahead in the banking sector might just be the incentive to do so now. Thanks for watching.